Here is the animation of graphs we'll discuss. We'll discuss IS-LM model in multiple videos. In this video, we'll derive IS function from investment and saving functions. In an economy, the level of investment is sensitive to the prevailing interest rate. We see here the negative relationship between the two. This is plot of the investment function. Higher the interest rate is, lower the investment, and lower the interest rate, higher the investment. In general, we can show investment function symbolically. Interceptor here is autonomous investment. Slope B is sensitivity of investment to interest rate.
Variables in an economic model can be categorized into either endogenous or exogenous. Values of endogenous variables are determined within the model. Values of exogenous variables are determined by forces outside of the model. A change in exogenous variable is called an autonomous change. This is the specific form of investment function we'll be using. Autonomous investment is 80 units of currency and slope implies that investment increases by 13 units if interest rate falls by 1%. This is inverse function of investment. As in economics, we measure interest rate along vertical y-axis. Comparing red and green points. We see at red point, with relatively higher interest rate of 5%, investment is at lower level of 15 units. At green point with relatively lower interest rate of 2%, investment is at higher level of 54 units. With an increase in autonomous investment from 80 to 120, investment function shifts forward. So, now, at a same interest rate as before, the investment level is higher by 40 units.
This is our economy-wide consumption function. 0.73 is MPC, marginal propensity to consume, and 52 is autonomous consumption. We represent national income by Y. Saving function, simply, is difference of income and consumption. We generate data for 12 interest rate levels, ranging from 0.5% to 6%. Plugging them in investment function gives us 12 investment levels, prevailing in the economy, for different periods of time. Investment ranges from 2 units of currency to 73.5 units. Notice, lower the interest rate, higher the investment level.
Equilibrium national income Y in product market is achieved when saving leakage from the economy is equal to investment injection. When we equate saving function with investment function, as shown here, we get 12 equations similar to this for 12 different interest rate levels. Solving these 12 equations, Mathematica gives us 12 economy-wide equilibrium levels of national income for different periods of time. These are the 12 equilibrium levels of national income. They range from 200 units of currency to 464.815. Assuming two-sector economy. That is, without government tax and international trade, national income is equal to aggregate consumption plus investment. That is, Y is equal to C plus I.
As a convention in economics, these equilibrium level incomes for different interest rates can be shown with help of 45-degree line. These are 12 C+I lines crossing 45-degree line. 12 intersection points are the 12 equilibrium income levels, where the respective savings and investments in the product market are equal, for 12 different time periods. The topmost intersection is where interest rate is the least and equilibrium income is the highest. The lowest level of equilibrium income is at the highest interest rate level. Here we show only 3 cases for better view: equilibrium income levels with interest rates 0.5%, 3.5%, and 6%.
As we did for 12 different equilibrium levels of income at different interest rates, if we keep the expression in generalized form while equating saving and investment in product market, and solve the equilibrium equation for y in terms of r, the function we get is known as IS function or ICE curve. Here, we transform it in inverse function form because by convention we measure independent variable r, the interest rate along vertical y-axis.
This is the plot of this curve for our saving and investment data. Here we show 12 points of interest rate and equilibrium income pairs on the IS curve, with 3 points annotated with arrows.
Here is the animation of graphs we discussed.